Problem 1, which is exercise 2.4 in your text, is asking us to do some accounting for an accounting firm. At which point you might say, why don't they do their own damned accounting? Well, because it's an exercise and that's what we're doing. Okay, so the first thing is they perform $70,000 of services, and the key word here is on account, and that's on account of they didn't pay for it yet. So that's accounts receivable. So our asset, the item of value that we earned by doing those services, is accounts receivable, $70,000, and that's revenue of $70,000. We have no expense to put against it yet, so right now the whole thing is net income, but we know that's going to change. The next thing they tell us is they performed $40,000 worth of services for cash. So this isn't on account, this is cash. We actually got this money. So our item of value that we earned was cash, $40,000. And like the other services we performed, that's revenue. And like the other services we performed, there were no expenses associated with it yet. We know that that's going to change. So let's see, we've done this one, we've done this one. Well, I told you there's expenses coming. Incurred. Incurred means we owe. It means we signed a contract. It means we agreed to pay. So these were incurred and these were on account. So we agreed to pay, but we haven't paid. So this has no effect on our cash, but it does affect our accounts payable. So we've agreed to pay $36,000 in accounts payable, and that's an operating expense, and we knew they were coming. So that would be a $36,000 reduction to our net income. It's not really a reduction, it's just a computation to arrive at net income. Next, they pay $10,000 cash to an employee for a salary. I will tell you that's fiction. In 40 years of public accounting, I don't know anybody who got $10,000 for a week of services, but we'll make pretend it's so. So we have $10,000 cash, and that's salary. Salary is indeed an operating expense, so we have to reduce our cash by $10,000. We have to recognize an expense of $10,000, and that's a reduction in retained earnings or net income, which will close the retained earnings. And it's really just a function of an expense. Now, we collected $47,000 cash from accounts receivable. I want you to see something here. I want you to make pretend that we have two buckets. One bucket's called accounts receivable and one's called cash. They're both assets. In accounting speak, we don't care if we got the cash or didn't get the cash. It's all an asset. So in this case, we're getting one asset, cash, and we're giving up another asset, accounts receivable. So we're just moving the money from one bucket to the other. So there's no real change in the value of the company. So our cash is going to go up $47,000, And our accounts receivable is going to go down $47,000 because we collected it. It has no effect on our liabilities, our payables, none of that. It has no effect on any of that. It has no effect on our expenses. It has no effect on our retained earnings or our income, because we just took it out of one bucket called asset, put it in another bucket called asset. No impact. That's important. Next one, we paid $16,000 cash. And when you see paid, that's kind of a code word for cash out on accounts payable. So this is not a new bill. This is a bill we've already recognized. So we're going to reduce our cash by $16,000. 16,000, sorry, my writing sucks. And we're going to reduce our accounts payable by $16,000 because we no longer owe $36,000. We've paid $16,000, so we only owe $20,000. And again, that has no effect going across the board because it's an event that already happened. We journalized it. We took care of everything. We're just now getting around to paying it. Okay, next one, paid $8,000 in cash dividend. Dividend, it's when you give money back to your owners. It comes out of retained earnings. It's just, you're giving it back to them, okay? You're giving it back. So that's $8,000 coming out for retained earnings. So that's $8,000 in cash, and that's $8,000 in retained earnings. Now, I want to go back for a minute. Well, let's do the last one, and then we'll go back and do them all at the same time. The last thing it tells us is accrued. Accrued means owed but not paid. That's what accrued means. So we owe our employees $2,000 at the end of the year. So that doesn't affect our cash, our accounts receivable. This is a very specific receivable called salaries payable. And that is indeed an expense of $2,000. And in the computation for net income, that would reduce our net income. Okay, now we've kind of ignored this retained earnings column because we've been focusing on the net income. But what I want you to understand is that although we have to do the net income statement to move the expenses and the revenue to retained earnings, the minute we have any transaction, there is an immediate impact on retained earnings. So, accounts receivable, that's an asset that we got. That increases retained earnings. Then we earn cash, $40,000. That increases retained earnings. We don't have to do the accounting right away, but it does increase the value of the company. Our liabilities, we owe somebody money. That reduces our retained earnings because the company's worth that much less. Then we have that $10,000 payment for cash, that's salary, that reduces retained earnings because it reduces our value of the company. Now, the next two, the asset shift, where we go from one asset to the other, that has no impact because, like I told you, we consider one asset just as good as any other. And on the liabilities, our cash went down, but our amount owed went down. So the company's in the same exact position as it was before. And then we gave out some of our retained earnings. And now we have this $2,000 accrued salaries. And I want to turn your attention to the relationship between these two columns, between the retained earnings column and the net income column. Notice that the numbers are exactly the same. The only exception being when we pay the dividend. Where's that dividend? What is that? Right here, $8,000. That's a reduction in retained earnings, but that comes out of net income, is not computed in net income. But all the others are exactly the same. So, the big takeaway here, any transaction has an impact on retained earnings unless it's an asset shift or you're using cash to pay a liability where the company's value stays the same, or when you're giving away some of your earnings, and that's a reduction to retained earnings. And if you do your math nicely, that's the ending balances. That's what we need, those ending balances. And just to be sure, you could add up this and it will add up to the total of these, okay? So, now let's answer the questions. First question they ask us is, what are the total assets? 53 and 23, 76,000. What's the next question they ask us? What's the balance in the accounts receivable? 70 minus 47, 23. It asks us then, what is the balance in accounts payable? It's 20. What we originally owed minus what we paid. And then it says, what's the total balance in accounts receivable, the money that's owed to us. So the amount that's owed to us is $23,000. That's owed to us. And the amount we owe is 20. So to us and from us. Item F is asking us, what is the net income for the period? Two ways you can get that. You can come down this whole column, or you can take the total revenue minus the total expense. Either way, you'll get the same at 62,000, the net income. And the last thing it's asking us is, I don't know, let's see, we start out with 61,000. See, minus 40, minus 10, so we have 40. Where's 40 coming at? Okay, 40 is cash. Okay, that's, so we have 40 in cash, minus 10, plus the 47 that we got, minus the 16. So they're asking us to balance before we pay the dividends, and that would be 61,000. This side's 62, I wrote 61. And that's net income is 62. And the cash account before dividends, 61,000. Kind of a long problem, but this was the hard part. You had to figure out where these pieces went, and once you did that, the following pieces were pretty easy.